If Iraq has some of the world's largest oil reserves, why does its banking system still struggle to earn the confidence of international investors? It's a question that has puzzled economists, frustrated business leaders, and fueled endless speculation among people who follow Iraq's economic future. Many assume the answer is simple. They point to politics, corruption, or conflict. While those factors certainly matter, they tell only part of the story. The real answer is far more surprising. Iraq isn't simply trying to modernize a few banks. It's attempting to rebuild the financial nervous system of an entire country after decades of wars, sanctions, institutional collapse, and rapid political change. Banking reform isn't a single law or one government decision. It's a chain of interconnected reforms where every weak link slows the entire process. Imagine trying to renovate the foundation of a skyscraper while people are still living inside it. Every repair has to be carefully planned because one mistake could affect millions of depositors, businesses, government salaries, and international trade. That is the challenge Iraq has faced for years. To understand why progress appears so slow, we have to travel back several decades. During the 1980s, Iraq's banking sector functioned under a highly centralized economic model. The state controlled almost every major financial institution, credit decisions, and foreign exchange activity. Banks existed primarily to serve government priorities rather than compete for customers or attract investment. Then came years of conflict, followed by international sanctions during the 1990s. Iraq became increasingly isolated from the global financial system. Modern banking technology barely advanced while the rest of the world was embracing electronic payments, online banking, international compliance standards, and sophisticated financial regulation. By the time sanctions ended and Iraq began rebuilding after 2003, the world had changed dramatically. Global finance no longer depended only on moving money. It depended on trust. International banks wanted proof that transactions were transparent, customer identities could be verified, financial crimes could be detected, and institutions operated under internationally accepted standards. This created an unexpected problem. Iraq wasn't starting from behind. It was trying to catch up after missing nearly 2 decades of global banking evolution. As oil revenues returned, many expected rapid modernization. After all, money was flowing into the country. But financial development doesn't automatically follow natural resource wealth. In fact, history shows the opposite can happen. Countries rich in natural resources sometimes postpone difficult institutional reforms because government income depends more on commodity exports than on a diversified private economy. Oil can finance a budget, but it cannot by itself create efficient commercial lending, digital payment systems, independent credit markets, or internationally trusted compliance frameworks. That realization slowly shifted Iraq's priorities. Officials increasingly recognized that sustainable economic growth required something deeper than oil production. It required rebuilding confidence in the institutions responsible for moving money safely, transparently, and efficiently. But rebuilding confidence is far harder than rebuilding buildings. And the next obstacle wasn't inside Iraq's banks alone. It was hidden within the rules of the global financial system itself, a system that had become dramatically more demanding than most people realized. Confidence in global banking is built long before money ever crosses a border. Every international payment, trade transaction, or investment passes through layers of verification designed to answer one essential question. Can this financial system be trusted? For Iraq, this became the next major challenge. Over the past 2 decades, international standards governing banks have become significantly stricter. Organizations such as the Financial Action Task Force, along with global banking regulators, have pushed countries to strengthen anti-money laundering and counter-terrorist financing measures. These aren't optional guidelines. They shape whether international banks are willing to maintain correspondent banking relationships, process cross-border payments, or finance major investment projects. For Iraq, meeting those expectations meant far more than passing new legislation. It required transforming how banks identify customers, monitor transactions, report suspicious activity, and manage risk. Every improvement demanded new technology, trained personnel, regulatory oversight, and coordination between multiple institutions. A modern banking system cannot function if only one part is upgraded while the rest remains outdated. This helps explain why reforms often appear slower than headlines suggest. A new payment platform or digital banking initiative may generate excitement, but behind it lies years of infrastructure upgrades, cybersecurity improvements, staff training, and legal reforms. Much of the work happens quietly, with little public attention, because successful financial systems depend on reliability rather than publicity. Another factor complicates the process. Iraq's banking landscape is unusually fragmented. Large state-owned banks continue to play a dominant role, while many private banks are relatively small and vary widely in their capabilities. Reforming such a system isn't simply about introducing competition. It also involves modernizing legacy institutions without disrupting services that millions of citizens rely upon for salaries, pensions, and government payments. The rise of digital payments illustrates both the progress and the remaining challenges. Electronic payment systems have expanded noticeably in recent years, reducing reliance on physical cash and increasing financial inclusion. More Iraqis are using payment cards, mobile services, and electronic transfers than they were just a few years ago. These developments represent measurable progress toward a more modern financial ecosystem. Yet cash still plays a dominant role in everyday life. In many communities, people continue to trust physical currency more than bank deposits, partly because decades of instability shaped financial habits that cannot be changed overnight. Building public confidence requires years of consistent performance, consumer protection, and dependable banking services. This reveals an important truth that is often overlooked. Banking reform is not only about institutions changing. It's also about society changing its relationship with money. Laws can be passed in months, software can be installed in weeks, but public trust develops much more slowly. And as Iraq gradually strengthens both its financial infrastructure and regulatory framework, an even bigger question begins to emerge. What could these reforms ultimately mean for Iraq's broader economy, foreign investment, and the long-term future of the dinar? That question is where banking reform becomes much bigger than banks themselves. A stronger financial system has the potential to reshape how Iraq participates in the global economy. But it's important to separate what these reforms can realistically achieve from what they cannot. One common misconception is that banking reform alone could suddenly transform the value of the Iraqi dinar or trigger an overnight economic breakthrough. The evidence doesn't support that conclusion. Exchange rates are influenced by a wide range of factors, including monetary policy, inflation, foreign reserves, trade balances, fiscal policy, and overall economic confidence. A healthier banking system can support long-term stability, but it is only one piece of a much larger economic puzzle. Where banking reform can have a profound impact is by creating the conditions for sustainable growth. Businesses are more likely to invest when they can access reliable financing. International companies are more willing to enter new markets when payments are secure and regulatory standards are familiar. Entrepreneurs can expand more easily when modern banking services replace slow, cash-based transactions. In other words, efficient banks don't create prosperity on their own, but they make prosperity far easier to build. History offers an interesting comparison. Countries such as the United Arab Emirates and, more recently, Saudi Arabia invested heavily in modernizing their financial sectors as part of broader economic transformation strategies. Their success wasn't driven by banking reform alone. It came from combining institutional reforms with infrastructure investment, regulatory improvements, private sector development, and long-term planning. Iraq's circumstances are different, but the broader lesson remains the same. Financial modernization works best when it is part of a comprehensive national strategy rather than an isolated project. There are encouraging signs. Iraq has continued expanding electronic payment systems, strengthening banking supervision, modernizing regulatory frameworks, and pursuing initiatives aimed at improving financial transparency. These developments suggest that reform is moving forward, even if the pace feels gradual. Progress in financial systems is often measured less by dramatic announcements and more by years of consistent implementation. Still, genuine uncertainty remains. Regional geopolitical tensions, fluctuations in oil prices, domestic political priorities, and global economic conditions can all influence how quickly reforms translate into measurable economic outcomes. Recognizing those uncertainties isn't pessimism. It's simply acknowledging that complex economies rarely change in a straight line. Perhaps the biggest lesson is that the question itself needs to change. Instead of asking, why is Iraq's banking reform taking so long? We might ask, how do you rebuild trust after decades of disruption? Viewed through that lens, the timeline becomes easier to understand. Trust cannot be legislated. It must be earned through thousands of successful transactions, consistent regulation, reliable institutions, and years of demonstrated stability. The story of Iraq's banking reform is therefore not one of failure or endless delay. It's the story of a country attempting one of the most difficult economic tasks imaginable: reconnecting an entire financial system to a global network that demands transparency, resilience, and confidence at every level. Whether that journey ultimately fulfills its ambitions will depend not on a single reform or headline, but on the steady accumulation of progress over many years. And perhaps that's the most important takeaway. The future of Iraq's economy won't be determined by one announcement, one policy, or one expectation. It will be shaped by the patient work of building institutions that people, both inside and outside the country, can trust. If you enjoy thoughtful documentary-style explorations of Iraq's economy, banking system, and the forces shaping the Iraqi dinar, be sure to subscribe. There's always another layer to the story, and we'll continue uncovering it together.